Dear participants, we're pleased to welcome you to the panel session 1, Settlement Efficiency, Strategies for Improvement. Efficient and timely settlement of securities transactions remains a cornerstone of stable and resilient capital markets. This panel will examine the latest strategies, technologies, and regulatory frameworks aimed at optimizing the settlement process across multiple asset classes and jurisdictions. Panel session moderator, Head of Turkey, Caucasus, and Central Asia SWIFT, Mr. Hikmet Yılmazsoy, and all of the panelists. Please welcome. Also, feel free to share your questions at any point. Just scan the QR code. It only takes a second. We'll try to cover as many as we can. Thank you.
Hello. Thank you very much for being here with us, and especially thanks to WFC for inviting us to the stage today. My name is Hikmet Yılmazsoy. I am based in SWIFT's Dubai office, and I am responsible for our communities in Turkey, Caucasus, and Central Asia. So as introduced in this panel, we will talk about key challenges and practical approaches for enhancing post-trade settlement processes. And we find that very timely and relevant at a time where we are discussing move to accelerated settlement, having implications on operational readiness, liquidity management, and also cross-border harmonization. Also at a time where we see CSDs evolving their businesses, evolving their operational models, and again, when we have the focus on technologies like DLT, tokenization, transforming the securities business. So the way we designed this panel, we will first start with setting the scene. We will discuss about current complexities. Then we will talk about the global response. We will explore what kind of levers and enablers we have at our disposal, particularly technology. And then we will conclude with looking into what comes next. So I have a very resourceful panel with me today, bringing insights from across different parts of the globe. So let me start introducing my esteemed panelists today. So we have Anna Kulik, Secretary General ECSDA, European Central Securities Depositories Association. We have Bruce Butterill, Executive Director for ACSDA, America's Central Securities Depositories Association. We have Nelly Dagdag, Managing Director for DTCC, Depository Trust and Clearing Corporation. We have Jesus Sanchez, Head of Settlement Services, SIX, and Chair of the Settlement Working Group at ECSDA. And at the farthest end of the row, we have Kevin Sampson, President for Canadian CDS. So having practiced most of the letters in the alphabet, which felt like an optician appointment at some point, let me start with my first question to my panel. So again, the aspiration of this panel is picturing how an efficient settlement ecosystem will look like going forward. And talking about settlement efficiency and strategies for improvement, let us start with existing complexities, friction points in the landscape as of today. So Anna, maybe we can start with you from the European perspective.
First of all, thank you very much. It is a pleasure and an honor to be here on this stage. Thank you, Jan, for presenting us today. So I have a difficult task because indeed you have asked not only to be picturing the current situation, but also to be particularly focusing on the challenges that we're having. By nature, I'm an optimistic person, so I prefer to be looking at the positive side of things. And today, indeed, we'll need to be starting with a bit of a challenging and critical point of view, right? So in Europe, I think we have an essence of the global challenges somehow. So today, within Europe, although we are trying to achieve a single capital markets union, we still very much live in the very fragmented world. And from that perspective, we have 27 markets with 27 national central banks, but particularly indeed 27 jurisdictions. And of course, for the CDs as natural notaries of the market, it does represent a challenge. And so this certainly leads to the liquidity fragmentation beyond many other fragmentations that we can be finding in our space. And that's a challenge in itself. But building upon this challenge, we have been trying to see what it leads as a challenge from the cross-border settlement perspective. And here as well, so this different existence of the jurisdictions, of the company laws, of the taxation regimes, of the central banks as well, which are serving as the cash leg, right, for the settlement of the securities transactions. We do see that we need to be taking into account the differences in the cut-off times and of the CSDs and of the central banks as well, and many other challenges and differences in the processes as well. Hence, in Europe, we have been very deeply going in the road, on the road of the standardization, have been trying to achieve indeed as much as possible further alignment on the SSIs, for example, on the use of messaging standards as well, many other matters, but indeed lots of progress still remains to be done in the future. To that, I would very quickly add the fact that indeed, although we are also probably beyond many other regions in terms of the automation, still, so the level of STP, even in Europe, is remaining to be perfected a bit further. And of course, so this leads to the fact that we're still seeing the liquidity concerns and the concerns with regard to the collateral reuse and collateral fluidity within the market as well.
Thank you, Anna. And let me at this point move on to Jesus, who might complement the European perspective.
Well, in Europe, we have a very active regulator that sometimes it makes it even more difficult than what we have, no? And in Europe, we started discussions about the settlement efficiencies with the implementation of settlement discipline regime that it was based in our regulator in Europe. The question was that, taking into account that the T+1 discussions and implementation in states were moving on, also this topic were put together in combination with both, no? T+1 could be a good reason to have more failings or not. And obviously the European regulators, I guess that you know the answer, no? Says no, impossible at all. We have to keep at least the same settlement ratio, settlement efficiency ratio than before the implementation. And you see the mandate from regulators goes in that direction. T+1 implementing in October 2027, 11th of October, a great deadline we have, but with keeping exactly the same settlement efficiency rates that for that time we will have. So this is the mandate is complete. With that, altogether, it has been emphasizing the discussions with them in order to do something or to start doing things in order to be able to do that. Because although 2027 seems quite far, honestly speaking, is the day after tomorrow in terms of technology, operationally, in terms of projects, no? So the first question that the regulator establishes that good settlement efficiency rates, but not only in trends, that obviously this is the key objective. The trend should be good, but not only in a month, in a year, but also you infrastructures, is when they mandate it to us, is you have to be ready to manage difficult situations on concrete dates even. When I was in that meeting with ESMA, I learned one new word in English, what it was, spike. I didn't know that until that time. Is when you have a big drop of efficiency or a big peak in inefficiency. You mean you take what you want. And the question is how infrastructures, and together with the communities, what we can do in order to be ready to do that, to manage that. What kind of spikes we can have. The most easy one to be seen is that market turbulences. Obviously, not needed to say about pandemic, although we have already forgotten, but 5 years ago, it's not too much. So pandemic, geopolitical questions. So, but not only that, if we dig in more detail, and in the T2S market settlement efficiency workshop that we have especially dedicated for T2S that I also chair, we were digging in, because ESMA requires that information, and we recognize that, of course, market turbulences, question about that, but also important things such as big players, big customers doing implementations in their systems, implementing new systems, implementing new features, moving one customer to another custodian. This kind of things also has to be addressed in order to avoid these kind of spikes. So it's more or less the discussion that we are having also with them.
Thank you so much for the insights. And Kevin, you are the voice of Canada and North America here. What would your perspective be on the current landscape?
Yeah, so just for context, Canada transitioned from T+2 to T+1 in May of 2024 in alignment with the United States. We didn't really have much choice given the interdependencies that are many between our market and the US market. Proximity is one of them, but we also have very healthy amount of securities that are cross-listed and very fungible between the two jurisdictions. So settlement misalignment certainly would have produced a big issue. But I think it's worth noting, you know, the move to T+1 certainly in North America wasn't driven necessarily by a recognition that there's an issue with fails, for example, or match rates. Obviously, there's always room for improvement, and we should always be striving for greater efficiencies in the settlement regime. But the genesis of it isn't embedded in there's a problem here. It's what's the art of the possible, and how can we make improvements? And where that's being driven from clearly is, you know, the stakeholder demands and the need for increasing liquidity in the market and driving more capital and collateral efficiencies. And we see that from, I think we all do, in our stakeholder base, whether that be the end investor themselves, institutional investors, the broker-dealer or bank intermediaries. There's a constant pressure, obviously, to optimize capital and reduce costs. And so, you know, that combined with de-risking your processes in the system as much as you can, all of this is coming together to, obviously, I would present that as a challenge, right? And saying, how do we collectively as a market make improvements so that we can improve liquidity, de-risk the system, and make more efficient use of capital and collateral. And so I think it's important that's kind of the genesis, and I think we all know that. Our experience with T+1, it was very successful. It was interesting, Jesus, you make the point about exceptions. And I think we found that from an experience perspective in that transition where, for the most part, the market did what they needed to do in terms of meeting their obligations, and certainly there was a regulatory imperative to maintain kind of the current level of settlement failures and institutional match rates. But it was, in the early days, certainly it was the exceptions that really were notable. And it was very important in terms of the market and our role as a CSD in terms of identifying those and working with the participants, because that helped triage where the bottlenecks might be in their processes and as they transition to T1. So it was a very interesting point there. One other thing I would add is part of the challenge is certainly in the Canadian market, and it was mentioned a little bit, I think, Anna, around the optimization of collateral. And I would say in Canada, the lack of automation around collateral mobility. And that certainly, that's a infrastructure issue within our particular jurisdiction, of which was an impetus as well, and a challenge that we use T+1 as an opportunity to take the market along in terms of developing that infrastructure in collaboration with our partners at Clearstream in introducing more collateral management and automated services, as well as some other services around security lending, automating the recall of security lending. And so it's the collateral and the funding space that we certainly have seen challenges in our market, that we use T+1 as an opportunity and kind of the momentum of the industry around those themes in terms of developing and driving new solutions in the market.
I think, and so far we heard from Europe and North America's. Nelly, if I turn to you, so how do they compare and contrast with your perspectives for APAC?
Thank you, Chan. Good afternoon, everyone. I'd like to thank the WFC and Kazakhstan Depository for having me in this panel. I would say the challenges that's been outlined for the other markets would equally apply to APAC markets, but there are certain nuances that are worth pointing out. Let me start with the market structure. So if you look at the APAC markets, these are vertically organized markets, result of the 1990s, where exchanges, CCPs, and depositories are consolidated. So with that, the issue of margin in some markets is less of an issue because they have other risk management tools that they can deploy, such as limiting the trading volume by working with the exchange, whereas in horizontal markets like the US, that's totally under the control of the central counterparty. Like the margin is a big thing for moving to T+1 in the US market. That's not gonna be a big thing for the US market, for the Asian market. The other thing about the structure is the APAC markets, you have, like in Europe, you have mature markets, large markets, and you have very small markets. And also, we heard in the morning, the infrastructure business is a volume business. And having worked for the Philippine Depository for 16 years before moving to DTCC, I see that from very small to a very large depository, the core process, the core activities really are the same. I used to joke when I left the depository that the things I did at the Philippine Depository were done by 10 people at the DTCC. That's just the magnitude of resourcing. So when it comes to reforms like T+1, the immediate issue you would have with the smaller depositories is capacity. How do you fund this thing? And it's not just the depository itself, it's also the ecosystem. How do you convince the brokers who are mom and pop shops in the smaller markets to actually spend for automation? And by the way, these challenges that we're talking about is not because of T+1. They've always been there. It's just that T+1 has triggered the discussion. So all these challenges will remain and will continue to be a challenge way past T+1. I always tell my colleagues in APAC, let's not even worry about T+1. Let's worry about addressing all these challenges way ahead of even talking about T+1. For example, simple thing as same-day matching affirmation, that's agreed upon as a precursor to T+1. You can't have T+1 if you cannot agree on T+0. There are other things in APAC markets worth considering. For example, the refund or the regulators in APAC markets is really fond of investor protection, retail investor protection. So you'll have a lot of consideration that has nothing to do with retail investors than you would have in other mature markets, because retail investors would be very important to the regulators because it has some political implication. And you'd have discussions such as some APAC markets are, for retail, are pre-funded, pre-delivered. So you have India and China. China, by the way, has been on T+1 since 1995. Did you know that? They've been on T+1 since 1995. And that's because they're 95% retail. There's no reason why you shouldn't be on a shorter settlement cycle if you're already pre-funding, pre-delivering. Anyway, I always say China should be atomic settlement in that manner, because the sooner you finish the transaction, the asset will be released. So, but that's only for the retail constituencies. For the foreign investors, you'll always have the challenge of time zone FX, which means that you'll have to have time to be able to process post-trade. So you'll have always this friction between the retail and the institutional, which would be more felt in markets, in APAC primarily. I'll stop there. Thank you.
Thank you so much. And when we look at LATAM, I would maybe believe, Bruce, that the market is more similar to Nelly's market, but let's hear from you.
I think I can make it very short, exactly what she said. I'll supplement it a little bit, but everything that Cornelia said, I think, applies to Latin America. And the reason I wanted to talk about Latin America and the Caribbean, because I think a lot of the challenges that are faced by smaller markets throughout Africa and throughout Asia as well. And I would capture them in various themes. One is the adoption rate for standardized messaging and communication. While it's improving, it is not where it needs to be. So creates friction in the process. Some of the confirmation and matching processes are still more manual than automated. So that will create friction on the process. The imbalance between T+2 settlement for foreign exchange transactions and T1 settlement creates another issue in terms of moving to T+1. And frankly, the volumes that exist in the market and the level of liquidity, the motivation is probably different. The prospect of increasing fails by moving to T+1 against preserving your market share and attractiveness. If you see an escalation in your fails levels in the market, that might discourage investment coming into the market. There's a tremendous amount of focus in the Americas beyond those markets that have moved to T+1. The organizations and markets that are particularly motivated to move to T+1 have really already done so. Markets like Argentina moved to T+1 along with Canada and the United States, as did Mexico, because the Mexican Stock Exchange and Depository does a tremendous volume of business in US and Canadian interlisted securities. So they had a tremendous motivation to move in that direction. So we're going to see a movement, but we're seeing heavy investment in updating technology that will provide the automation required to make the move. So I think in the next 18 months to 2 years, we'll see a tremendous movement beyond the large markets in the Americas towards T+1 as they are better positioned to do so.
Thank you so much. As we set the scene, I could capture some points in terms of automation, harmonization, standards, interoperability. Now, let's explore the global response to the challenges that we have mentioned for the first question. And here I can start with Kevin. And how do you see the global and the regional response to the challenges that we have explored? And particularly, if you could mention some concrete initiatives, developments with regards to addressing those challenges, we will be happy to hear.
Yeah, certainly I can, maybe I'll first start just some observations around our experience in the transition to T+1. And I mean, obviously the challenges we all talked about, you know, clearly globally, the immediate response is let's condense the settlement cycle. And a couple of observations from our experience I think would be worth sharing. It's the type of transition where so to speak, you can't leave anybody behind, right? Like we all operate in a local ecosystem with our market participants and an extension of that more broadly globally. And we all know there's two parties to a transaction, right? And to a settlement. And one could be fully automated, have invested in the tools, in the modernization of their workflows, and the other has not. And that's going to result in issues, right? And so, we spent a lot of time through the T+1 transition, both as the CSD market leader through that transition, as well as, industry groups and our participants, in ensuring that there was a bit of a level playing field in terms of the awareness, the knowledge, the support, in terms of that transition. Now, that's not to say that, different market participants with different capabilities, different scales, different business models had to invest in different ways. Some people just threw people at it. A lot of people just threw people at it. Where others took the opportunity to invest in better tooling, reworking their workflows and such. And so either way, regardless of how you get there, it was important that the market moved along at a similar place, because it would have been a significant issue if half the participant base weren't ready and the others weren't. And Nelly, kind of on your point in terms of, I think it's a really good one that, everybody's got their own priorities, and prioritizing the investment needed for this transition is, or any type of transition is difficult. And that's why a clear regulatory mandate is necessary, because, otherwise all our institutions are inherently to some degree lazy, right? And unless we're forced to do something of that magnitude and make those investments, we'll divert that focus somewhere else. And so it's very important to have a very clear regulatory mandate in terms of what's expected, what the dates are, and have that as early as possible. We saw that in Canada. Until that was very clear and made clear by the regulators, there was a lot of talk about transitioning to T+1, but nobody really put any effort into it until it became really real. I think the tooling aspect is interesting in terms of what's happened and how these challenges are being addressed. As a CSD, we saw the T+1 transition as an opportunity in terms of how can we better service our stakeholders and our participants, and identifying where are they challenged the most and the friction points as they look at transitioning. And so, as I mentioned earlier, stock loan recalls is a very manual process, or has been in Canada. A lot of phone calls being had, and so we developed better services to be able to automate a lot of that. The collateral mobility I had mentioned earlier, and so DTCC even, we had a lot of discussions around their institutional trade matching process and applying that to the buy side in Canada. And so it was a really opportunity for us as a CSD to look at ways how we can better serve the market and be a trusted solution provider to the marketplace that were having issues transitioning. The other area that was really interesting it's about data and insights, right? And participants, are going to drive settlement efficiencies, partly due to increased ability to be able to predict and manage failures as well. And so we saw a significant demand from the industry in terms of having greater insights, data and services around predictive analytics around failures, and to try to, from a pre-settlement basis, mitigate failures through those insights. And so that's certainly a trend that we're seeing continuing to this day. A year and a half after T+1 is a focus on how do we prevent failures in a proactive manner.
Thank you. And Jesus, if we proceed with you, I know that you have some perspectives on the settlement efficiency in Europe, particularly maybe with some statistics from the T2S.
Yes, I will try not to repeat many things, because, for example, what Kevin has said, please take it now, because fully agree with Sebastien. No. And I think that the first, when we started in Europe to discuss about efficiency, a part of the regulatory pushing for that, we, CSDs as community, we were taking this topic very seriously long time ago, before even the supervisor started on the discussions on that. And I think I fully agree with Kevin that the first question is not to start doing things without any plan. Usually when you are in a hurry, you start moving on. Where are you doing? I don't know, but I have to go. But where are you plan? No, I have to go. I think it's much better to have a little bit of relax, think a little bit. And what we have done in ECSDA, supporting the respective national communities or CSDs communities, is to try to coordinate in order to transmit and even put more clear the things that we have from authorities and also sharing views among CSDs. Because at the end, when something is successful in one place, probably you have to think about the possibility that in your place also could be a story of success, no? It could be not, but it could be the case. So the question is that a long time ago, we started a discussion about new features, like implementing partial settlement, partial release, prioritization, linking, a lot of functionalities that everybody is aware of. The question is not only doing that, but doing in a coordinated basis with engagement of the community, because at the end, the infrastructures, we can do many things. Indeed, we can do many things. It's part of our responsibility and our role as a leader. But nothing will change if the main players, for not saying everybody, and their clients, and the subsequent clients of the clients, the whole chain, doesn't implement the same good plan. You can do many things, but the bottlenecks can be in everywhere. So at the end, the question is to work together in order to do it smoother. And just for going to statistics, the question was that when we did some plans, we have, as the chair or the leader of the panelists has mentioned, in ECSDA, we have the settlement working group, but there are others that at the end go in the same direction, that this is the critical point. And the question is not only implementing, but be sure in the monitoring of those implementations, because if you say something but nobody follows, at the end the question is to be seen, to see that everybody goes in this direction. And when we saw, and now jumping to the concrete question, is that when we start in this monitoring, we have an acceptable settlement efficiency rates, acceptable. One question to say is that the regulators always been saying that we have to have good settlement efficiency rates. But when we have moved back to them saying, what do you mean by that? Give us a figure, 95%, 96, 99.9? They never come to us saying, this one. Now you have to improve. Okay, we take the origin. We see good, acceptable settlement efficiency rates, and the situation was improving month by month. True that what I have said before, the pandemic, the geopolitical questions, that some disturbances, some key questions, it's not a continuous success storyline. No, it's dropping, going up, dropping, but at the end, the tendency is clear. The trend is clear. It's a story of success, especially when you see the settlement efficiency, and I'm going to take 1 minute just for 30 seconds for a small technicality. When you see the settlement efficiency on value, because you can assess the settlement efficiency by number of transactions on volume, or you see how much cash you settle on value. And you see on value, you see good improvement in Europe. Very good improvements in general terms, of course. There are exceptions, as always. The question is not so much in volume, because the methodology followed or set by the regulator penalize the partial settlement usage in that case. Doesn't give us so much good results. But the question is, you see, and I fully agree, the question of T+1 in the future is liquidity, not because we need more agency for us operationally. Operationally, I think we do not have an issue. The question is to have more liquidity, more cash available, more collateral available. And in terms of liquidity, we see a clear good trend in Europe. So, room to be done, for sure. CSDs, we are not only, always we are unhappy. We want more, every single minute. At the end, it's part of our nature, no? We need more. But we can say that we have done a good way.
Thank you. So you have asked about the global answer to the question. And from that perspective, I think we need to recognize that we have failed to provide the global answer to this very common challenge, right? And I think it is a pity that we have not been able to align on the single date or at least a single year for all the regions, indeed, or at least the major capital markets across the globe. And I do hope that for the next moves, we will be able to correct it. Now, from the regional European perspective, I will try to be quick. I think we're already very talkative on the panel. But so what we're doing in Europe is that we have tried to correct at least this global challenge that we have seen that has resulted indeed in the misalignments of the key dates, for example, from the corporate actions perspective and many other challenges, particularly the liquidity gap for the funds as well because of this misalignment. We have considered that it is fundamental for the region at least to be aligned. And hence, from the UK, European perspective, and Switzerland, so these three major, indeed, regional players have been able to align on a single day. And so asking about the roadmap, I would say that we have a clear roadmap which has been developed in Europe. We are knowing what we need to be doing by the 11th of October 2027, which is the date of implementation of T+1 in Europe. And here, indeed, on the CSD side, we have, indeed, a very clear roadmap, and we certainly will need to be looking at certain things, certain developments at our level. So such as, indeed, well, we already have extremely sophisticated and very advanced systems in Europe, but still beyond that, of course, we're listening to the market participants, to the investors from the different regions, and trying to address these needs. It might be that, indeed, in some cases, as I think was mentioned by Brian from ICMA, we might need to be finding the solutions. Whether they will be implemented by October 2027, or a bit beyond, that's really a question of conversations in the market. And it's largely a question of the cost-benefit analysis and whether that's a nice to have. And from that perspective, whether we absolutely need to have all these tools by the day of the move to T+1, or whether the settlement efficiency levels can be already achieved with the current levels. And probably it's rather not the infrastructure, which is already sophisticated as mentioned, but more the market participants, so that certain improvements are also done on their side, such as, for example, automation, right, across the entire chain, which certainly impacts not just the CSDs, but also some of the market actors. And then, so what also needs to be happening is that in Europe we have noticed that the settlement efficiency rates are not the same for all asset classes. And clearly, for example, for ETFs, we do see a gap and a further possibility to improve by indeed trying to address the structural concerns in the ETF markets regionally. So that's broadly a plan. Thank you.
Thank you. So far I sometimes heard that the glass was half full, sometimes like half empty. So Nelly, from your perspective, is it full, fuller, half empty? How is that?
You're talking to another positive person, so it's always helpful. I always believe things are getting better. I mean, for Bruce and I, we were here in 1999, first WFC. Things have gotten better since then, so on all fronts. But going back to how the global challenges have been addressed, I think I would like to point out two things. On the part of the depository, and this is like what I always say, the depository is looking forward to moving to shortened settlement cycle. Look at that batch settlement window. We're all reliant on that batch settlement window to process transactions, when to deliver the securities, release securities, exchange the cash, and so on and so forth. That's going to be major change on the part of the depository. The other bit, more on the institutional trade processing front, is really automation and straight-through processing. And just for information of the others who are not so familiar, DTCC actually exists. We have clients in APAC because we do have institutional trade processing services for global customers who trade into multiple markets. That's one bit. The second bit is the global trade repository business for OTC derivatives. Because I've been asked a few times whether DTCC has a depository business in APAC. We don't. We're still a US depository, but we service our global clients. For the institutional trade processing part, one of the key things that has helped the move to T+1 in the US is really the same-day affirmation matching, the 9 p.m. affirmation cutoff, which was sort of mandated, but not really, because there are many ways of settling in the US market, many trains, I call them. But anyway, what has been done for the Indian market, and I see that is also being discussed in the European market, is the extension for the deadline for the affirmation, specifically for foreign investors. That was a big discussion for India because, of course, the time zone differences, but simply extending the time zone, simply extending the cutoff period for those foreign investors seemed to have solved the problem. And maybe that's a thing that we need to consider whenever markets would move to T+1. The other one has been said earlier a bit, but I think we cannot underemphasize the importance of the collaboration between the industry, the regulators, and the market infrastructures. In the US, that was such a big lift. Like, I was talking about the T+1 playbook. There was a T+2 playbook. We have to have playbooks, whether it's as detailed as a 400-page in the US or a shorter version, but you have to have playbooks that everyone knows what to do at a certain point in time. The other successful action that was done in the US was the conversion weekend support. So the industry had a 24/7 support during the conversion weekend where everybody gets to share what's happening. That was really very instrumental to the successful conversion.
Just picking up on the concept of the glass being half full or half empty, I'll go with the half full. I'm not always the most optimistic person, but I think the question is if the glass is half full, you need to drink out of the glass as well. And in many smaller markets, they're facing the challenges of growing their business, bringing about increased automation, refining their processes, all of which will help in the path to shorter settlement cycles. But I think while we have a tremendous amount of talk and analysis about moving to T+1 in many markets within Latin America, there's also a great number of other priorities in terms of growing your business, making sure that you're sound financially, and dealing with those issues. And when you have small market infrastructures and the number of challenges facing small market infrastructures, and given the profile of the business that they do, where does moving from T+2 to T+1 rank in terms of their priorities? So, sort of off topic, but it is a bit of a reality check, and I don't think it is exclusive to markets in the Caribbean and Latin America. I think probably applies to many small markets in Asia and Africa, that is the reality check. What is the net benefit? And when the major markets like Canada and the US moved from T+2 to T+1, who are the net benefactors of that move? The people putting up the collateral, really, right? So translate that into a smaller market and say, who is going to be the benefactor of us putting tremendous effort into moving to T+1, and you say, well, when we're trying to sustain our business, is that the best application of our limited resources? I know that's a bit of a downer for the focus of the panel, but I think that is the reality of the situation in many small markets across the world.
And having discussed the landscape and the global response, so now let's, and as we approach to the end of the panel, so let's discuss what is still missing, what kind of strategic levers or enablers we can benefit from. So technology being one of that. And whenever we talk about technology, it is most of the time hype versus reality. So is technology really at a point to help us to address or help with some of those improvements that we are expecting? And what else might help more? What else might still be missing in the roadmap? Yeah, Bruce, please.
I'll keep it brief, but just with respect to technology and that being a vehicle to get to shorter settlement cycles, never in my career have I felt that there's such a level of, we talk about blockchain and AI, but I don't think at any point in my career I've sensed that there's been a bigger focus by market infrastructures in developing and implementing traditional technology solutions for their core business. So it's a little bit in conflict with all the talk we do about these emerging technologies there, and I think the vendors from CMA to Nasdaq to Montran to Percival that are in the room, sorry if I missed any, TCS, apologies, TCS, would attest to that I think they're seeing a strong impetus towards developing and implementing traditional core systems. So while DLT and other technologies are making an impact on our business, CSDs are making long-term investments of 10, 15, 20 years. I know of CSDs that are replacing traditional systems after 30 years, so they're still committed to that path, notwithstanding the new technologies.
Bruce, if I may add, I mean, it's an interesting point. I mean, the reality is, unfortunately or fortunately, you have to do both, right? Like I agree. I mean, we operate foundational infrastructures, and we need to ensure that we're constantly modernizing. And you're absolutely right. I think all around the world, CSDs are constantly going through that evolution of upgrading their systems. And I think tying that back to settlement efficiency, you can drive a lot of benefits for settlement efficiency just by nature of modernizing and upgrading your systems. We've just went through a significant multi-year upgrade on the TCS bank system, and just even through that, reviewing and spending a lot of time looking at the settlement optimization model and looking at the sequence in which you're processing settlement transactions, and when are you utilizing collateral versus line of credit, and really focusing on that, you can extract a lot of value in making improvements. But at the same time, the reality is, it was debated and discussed on a previous panel around whether are we as CSDs going to be disintermediated and will our businesses survive. And I think the reality is, digital and emerging technologies and tokenization and stable coins and AI models and machine learning models are all they're all things that we need to be developing roadmaps and plans for, because that's going to be the future of our business. And you see the level of investment taking place around the globe by ourselves and our peers. It's happening now.
Thank you. Very briefly, note that the time is fine, to say that I think building upon what Bruce has mentioned and what Kevin has mentioned, we need to be caring from the perspective of how do we as CSDs are helping the investors and the issuers, right? And from that perspective, it is essential that we're trying to defragment, right? Not creating this additional flow of fragmentation through the DLT. And from that perspective, it's fundamental that we start not with the settlement, but with the issuance. And as soon as indeed the issuance is tokenized, and that many of the large networks of participants are using then the assets indeed which are tokenized already, then we can be asking ourselves which technology is most appropriate indeed to then proceed with the settlement. But for settlement, starting just with settlement engine, what we have seen in Europe is that we are currently not seeing major benefits just to use it for settlement purely, because the costs are still high and the technology is not purely very scalable. Though it is fundamental to be looking at it and making sure that we are ready for the next stage, that we are ready to accept different types of assets, including digital assets, including stable coins, including wholesale CBDC as well, and that and including for DVP and for delivery versus delivery as well, right? And that's part of settlement. And from that perspective, we need to be seeing and visioning the future as well as being the necessary providers as a one-stop shop. Thank you.
Thank you so much. And Nelly, we will conclude with you, but let me turn very quickly to Jesus if he would like to complement.
Just very quickly, I think in terms of technology, I don't know if everyone knew already, but the US SEC has given us approval to move to the cloud. It used to be that our core infrastructure for the depository clearing CCPs couldn't be moved to the cloud because of the regulatory constraint, but now we are very committed to the cloud. That has very clear savings as well. There's a lot of material to be had to justify that. The other one is 24 by 5 trading. So the equities market, like us, NSCC, has already made our universal trade capture earlier. So we used to start accepting trades from the exchanges and alternative trading markets at 4 o'clock in the morning. We've moved that to 1:30 a.m. and we're moving that further next year, June, to 8 p.m. Sunday for trades one day. So the trading day would be Sunday 8 p.m. to Monday 8 p.m. is a Monday trade. 8:01 to 8 p.m. Tuesday is a Tuesday trade. So that's the technology aspect that I would like to share.
Thank you. And Jesus, any final remarks?
Very short. It's like when you go to a doctor, you would like to have a general medicine, or you want something very specifically that solves your issue. Here is exactly the same. DLT is not the medicine for everything. DLT is good for business cases, specific questions, and something like that. In terms of efficiency, DLT is not the best solution. I'm not saying that cannot be used. I'm saying that it's not the best solution. So we have to look for that.
Okay. Thank you so much for the very valuable insights. So we will be around for any questions you might have. So I had a couple of questions when I talked to our colleagues regarding the harmonization of the timelines of the market shift to T+1, and also regarding some specific use cases with regards to technology as a heads up to the panel. So please feel free to approach and come with the questions. Again, thank you very much to the panel for the insights, and thank you very much for listening to us.
Thank you very much. Now we invite our speakers and moderator to take a group photo. Let's make a beautiful picture. Please present memorable gifts to the participants. Thank you very much. Let's welcome the keynote speakers who join us from Washington. Lead Financial Sector Specialist, World Bank, Mr. Sebastien Boitreaud, and Senior Financial Sector Specialist with the Finance, Competitiveness, and Investment Global Department, World Bank Group, Mr. Giorgi Laliashvili. I guess...
So, okay, very good. So we would have loved to be present in person for the conference. It was not possible due to logistics, but great that we can present virtually. So George and myself, we are both working in a unit of the World Bank, which is focusing on long-term finance and the development of domestic capital market. So today we thought it would be useful to present you the implementation so far of a new framework called the Local Currency Bond Market Development Framework that we developed with the IMF in 2021, and which, among other things, look at the importance of financial market infrastructures for the development of government bond market and domestic capital market in general. So we have a presentation. So if it's possible to move to slide number 2 on the presentation. So the local currency bond market framework, which is based on a guidance note and an Excel-based spreadsheet, has been developed on the back of more than 25 years of technical assistance by the World Bank and the IMF on government bond market development across the globe. And it was considered particularly timely in 2021, when governments were more and more relying on domestic sources of finance in local currency to fund their fiscal needs, budget and deficit. To do that, to reduce currency risk, to improve the maturity profile of the debt, to diversify the debt portfolio, and to reduce the reliance on external funding sources. It was timely. It was not, of course, something that was expected, but it was also timely because it was as you remember, the peak of the COVID pandemic, when a lot of countries had to switch towards internal sources of finance for themselves. So the framework, the LCBM framework, tries to establish a comprehensive instrument to assess how a country is performing across different indicators, and how to streamline technical assistance that could be provided over time. So the idea is, as much as possible, to help countries prioritize what needs to be done, which include, among other things, financial market infrastructure improvement, and in some cases, just basic development, and as well to coordinate the support from international donors, development financial institutions. If we could move to the next slide, please. So the LCBM framework is based on two main sets for the assessment. One is about what we call the preconditions, the enabling conditions. It's the fact that to develop a liquid, efficient, safe capital market, you need a certain number of preconditions to be established, or at least sufficiently established in the country. So I won't list all of them, but basically we are talking about the macroeconomic environment, the structure of the financial sector, especially whether there are non-bank investors that could participate to the market. The monetary and exchange rate condition is inflation, dollarization issues in the domestic financial sector, as well as the overall soundness of the financial sector. So those are the enabling conditions that need to be assessed prior to the specific assessment of the 6 building blocks of the local currency bond market. So the 6 building blocks are listed in the slide. They cover money market, primary market, secondary market, investor base, legal and regulatory framework, as well as financial market infrastructure. So of course, all those building blocks are somewhat interconnected, but we thought it was easier to look at 6 different blocks to assess whether a specific country is performing, which strengths and weaknesses they have in terms of government bond market and overall market development. Next slide, please. So basically, the assessment is done, the building blocks, the indicators within the building blocks, which I will cover in a few seconds, are done against 4 stages of capital market development. Stage 1 is nascent stage, so no functionality or almost no functionality. Typically for financial market infrastructure, it will be a country with no law on dematerialization of securities, no CSD, or just a registry based on an Excel spreadsheet managed by the central bank or the treasury in the Ministry of Finance, but no specific settlement system, everything being done by changes in account by the central bank. Stage 2, it's developing. So some functionality are present in the market. Usually a primary market is functioning more or less. There is a legal and supervisory framework, but other are still lacking. Usually secondary market is very, very illiquid. Stage 3 is emerging, so all the basic elements, all the basic blocks are established, and stage 4 is fully developed with all functionality well performing. Next slide, please. So the financial market infrastructure building block of the LCBM framework is looking at how an efficient, modern, safe FMI is supporting the underlying liquidity and development of the primary, secondary market and of the money market, especially through supporting collateralized transactions such as repo. Also, how FMI is supporting the efficient payment of capital and coupon on due date to investors, how access is ensured in a transparent and fair manner for all credible investors, directly or indirectly through omnibus accounts, and also whether liability management operations such as debt buybacks, debt exchanges are facilitated for the issuer, and they are usually quite important to for the issuer to reduce rollover refinancing risk. Next slide, please. So the building block on FMI looks at whether there is a safe, cost-efficient, accessible, secure, and resilient market infrastructure, if there is a legal basis for all the operations, protection of the investors, whether the credibility, reputation of the market is impacted negatively by an FMI which is not doing properly what it's supposed to be doing, whether there are fails in the market, operational risks, operational errors that would prevent the smooth functioning of the market. More or less, it's really consistent with the governance and operations standards that are internationally respected through, for example, the principle for financial market infrastructure of the CPSS and IOSCO that all of you know very well, I'm sure. Next one, please. Next slide. So the building block on financial market infrastructure will look at 8 different indicators to assess the degree of development of FMI in a given market. And every indicator will be assessed through a list of different questions, which are detailed in the guidance note. By the way, the guidance note on LCBM is available on the website of the World Bank and the IMF. It's translated not only, of course, in English, but also in Spanish, in French, and in Russian. So there are many ways to look at this document. So back to the indicators. Those indicators, I will not go through them in details in the sake of time, but they cover technology of the platform, registration of securities, custody of securities, whether clearing and settlement risk are properly addressed, the governance and access policy to the FMI, market segmentation, which is important, especially if there are, for example, 2 or 3 central securities depositories in the market covering the same issuers, liquidity support provided to the issuer, but also market participants to avoid fails, and regulation, supervision, and oversight of the market. Next one, please. So as part of the guidance framework, we conducted with the IMF a survey of 32 countries from different regions, different stage of development, all low income or emerging middle income. And the results of the survey are available in the guidance note. So here it's just really to as an illustration, you have 2 of the charts that were developed and which shows on certain risks or challenges how low income, higher and upper middle income country do position themselves, and by region as well. I'll stop here on the presentation of the guidance framework, and now I will let my colleague Giorgi present how the results and the lessons learned from the implementation of the framework. Thank you.
Thank you, Sebastien. I hope you can hear me well. Greetings to everyone, to the participants. I know there are many friends sitting in the audience, and sorry to just connect remotely, but I'm glad to together with Sebastien to be able to join you. As you see on the screen, next slide, please. Thank you. So as you see on the screen, we show the global coverage of the countries where the LCBM diagnostic has been conducted, as described by Sebastien. So it's 19 countries already and counting. Just want to mention here that it's on request basis. So if you don't see your country on the list, it is possible to request such assessment and diagnostic in the future, and we'll be more than happy to support that. Next slide, please. So here we have summarized, based on the work that has been done in those 19 countries, so how the heat map at the rating of different building blocks looks like across the countries and across the different income country groups. And so the greener, as expected, means that better scoring. Yellow or red means that there is room for improvement. So some general conclusions are that the emerging markets, interestingly, and that's good news, I think, are better scoring in the financial market infrastructure and related legal and regulatory framework, especially that's prominent in Asia, Middle East, and Central Asia. So in the low-income country groups, particularly in Sub-Saharan Africa and Asia, so the biggest challenge is secondary market and investor-based development. But overall, interestingly, and I think that's great news for the FMI community, the FMI building block, as you see, it's on the right side, so it scores relatively well compared to the other building blocks. Next slide, please. So on the next couple of slides, we summarized the main takeaways from the country assessments done so far. We have noted that there is a better recognition now across the countries of need and importance of having efficient and modern financial market infrastructures, the CSDs. And we've seen that there's increasing number of countries who have established well-functioning CSDs or are developing them. But many countries, they still operate multiple CSD, which under certain circumstances is fine. That's not a shortcoming, but they have limited interoperability and integration, which is an issue. And that leads to market fragmentation, and especially it limits access for various groups of investors. So while usually, typically, the banking sector, commercial banks, they have a better access to the FMI infrastructure and their systems, and they can fully participate in operating the securities market. But other types of intermediaries and investors, they usually struggle a bit more with having similar level of access to the FMI. And that situation, the infrastructure fragmentation, is often an important barrier to market development, as we have seen across the countries. Another observation is it's critical, and that also comes out of the issue of fragmentation, to have FMIs good access to the central bank RTGS, so that the security settlement happens in the central bank money, not a commercial bank money. And related to that, there is a good access to the central bank liquidity management and providing instruments, which obviously the central bank has to have those instruments, but then there should be easy access to them. And those instruments help speed up the settlement and help improve efficient liquidity, management within the banking system. And overall, these access and liquidity instruments are essential for smoother and better functioning of the markets. And where such access is restricted, we have seen the market struggle. Another observation is the FMI and the systems are quite complex and expensive. And in many smaller markets, this expensive infrastructure needs public sector support, especially that's relevant to the early stages of the development. And that's where we've seen the central bank role. Frequently, the central bank either acting as a CSD, usually that's for the government securities, or in other circumstances, central bank being a shareholder of a standalone CSD, covering either entire market or just government securities. Next slide, please. So it's important to note, and we've seen that again from many countries, that establishing a well-functioning FMI, it takes time. So it's not something that can be done fast. It's a multiple-year project and process. So it takes a lot of resources, and frequently it's impossible to be done in a full scale without external support. And such support may arrive from international development partners like the World Bank, or frequently and importantly from other CSDs. And that peer-to-peer support and experience exchange frequently is very efficient. And we've seen in many countries more developed CSDs and FMIs helping the others to improve functioning of that sector in other countries. So it's a good trend that most countries are now using standard, readily available IT solutions for their CSD operations and custody and settlement, except for maybe very large markets which have specific needs but also have more resources. And where countries have tried to develop in-house systems, so in most cases, those have been very, very long projects, often unsuccessful, and not as efficient solutions as with the out-of-the-box system. So that the trend of increasingly adopting readily available systems that comply with international best practices, so that's have been a notable development. Many countries try to create access to their markets for international investors with the help of ICSDs. And so while that's a compelling initiative, we are afraid that it's not always a realistic option for some countries, especially the low-income countries. They have struggled with that. So finally, we've seen that proper reconciliation procedures and processes that ensure that the records on individual beneficiary investor level are regularly, ideally on a daily basis, reconciled with the custodian records or the CSD record. So that procedure, which is very critical for the integrity of the market, may be missing or underdeveloped. Next slide, please. Another important lesson and then message is that while systems are good, the FMI cannot really perform its functions well unless there is a set of laws and regulations that support secure functioning of the securities market. And here on this slide, we listed some of the important pieces of legislation that are relevant. And we've seen increasing number of countries adopting those legislation, either as standalone laws or part of the other laws. And those are the legal bases that govern the establishment, operations, and regulation of the FMIs. That's legislation that defines the legal nature of dematerialized securities, defines the concept of the settlement finality and the irrevocability for both cash and securities, that enforces and ensures segregation of the client assets from the assets of the custodian or the CSD, and then enforces the concepts of legal netting and closeout netting, as well as use of financial collateral and repo. So these are all very important concepts that need to be supported by the local legislation to align the securities market with best standards, as well as to ensure investor protection and uninterrupted functioning of the securities market. Next slide, please. So we were thinking of some of the benefits from the LCBM framework and assessments that we are doing across the country. So what are the specific benefits for the FMI community? And so just note that there is a set of regular in-person workshops that are conducted globally that are used for capacity building, and there are online training materials that are available more broadly and publicly accessible to more interested parties. The LCBM work that is being done globally, we think it reinforces the importance of the FMI because it's recognized as one of the key building blocks for market development, and that attracts great attention from the policymakers at a very high level. So we hope and we think that it supports your work as well, because it underscores the importance of the FMI and the CSDs. So the LCBM framework, it helps to create a knowledge base of success cases or maybe some failure cases as well, which are equally important to be aware of, to take into account when designing the reform plan. So we think that's an important resource. So it's also a methodology that can be applied with external help or even internally as a self-assessment, and that helps identifying areas for improvement. And a reform plan that eventually will lead to accelerated market growth, and the bigger size of the market also means that there's more business for the CSDs. It's a good tool for benchmarking your work versus other countries, peer groups, other FMIs, and again, a good resource for identifying areas where you want to improve, or maybe you are doing already great. And there is additional work that complements the LCBM that's done by the World Bank Group and the IMF. Something I'm sure you are aware of. Those are the financial sector assessment programs that are done regularly, and there is frequently a technical note on the FMI. And again, there's a vast resource of different publications, notes, and the knowledge products that we produce and update, and those are available and helping the markets to countries to develop their securities market. So here I hand over to Sebastien again for the final.
Thank you, George. So I think we are already in excess of time, so I will be super short to thank you all for your attention. And just to reiterate that World Bank, IMF, we are available and ready to discuss with you to see how we can support. I understand that George and myself, our contact information will be shared, so do not hesitate to reach out to us. We'd be happy to follow up bilaterally as needed. Thank you very much.
Thank you, everyone.
Thank you. Dear participants, let's take a short break for informal communication and networking with colleagues. The break will last until 15:50.